This is a summary of the book How to Trade in Stocks by Jesse Livermore. Dive into Jesse Livermore's timeless wisdom in How to Trade in Stocks, where a legendary trader reveals simple ways to beat the market. Learn how to time buys and sells perfectly, cutting losses fast to avoid wiping out your savings. This book tackles real problems like fear and greed, teaching patients to turn small investments into big wins. Discover record-keeping tricks that spot trends early, solving indecision in volatile markets. Apply these practical tips today for smarter, stress-free trading. Let's begin. Let's find out more.
It's always a genuine thrill to get into a text like this one. I mean, we look at so many books on finance, and a lot of them are, of the moment.
Right, they're about a specific trend.
Exactly. They're about crypto or a new app or some strategy that works for 6 months and then just vanishes. But then you have these foundational texts, the ones that are just bedrock.
And this is definitely one of them. I mean, we're talking about Jesse Livermore, the boy plunger. The man is practically a myth on Wall Street.
He really is.
Just for context, for anyone listening who might not know the full story, this is the person who famously shorted the 1929 crash. While the entire global economy was collapsing, Livermore walked away with something like $100 million.
In 1929, which is just, it's a staggering number, billions today. It's a level of market timing that seems almost supernatural from the outside.
It does. It feels like he had a crystal ball.
But that's the beautiful thing about this book, How to Trade in Stocks. He spends the entire time dismantling that myth. He's practically yelling from the pages. It wasn't magic.
Right.
He's saying it was a system. It was discipline. It was mathematics. And crucially, it was psychology. And it all started with treating speculation as a serious business.
And that's really the core of Chapter 1, isn't it? The challenge of speculation. He starts with this very stark warning.
He does. He says, look, this is the most fascinating game in the world. But then he immediately follows up with the conditions. It is not for the stupid, the mentally lazy, or anyone looking for a quick payday.
Which is funny because he got rich so fast. But he's drawing this very clear line between what he does, which is speculation, and what most people do, which is
gambling. Pure and simple. He saw the stock market as a place where millions came to roll the dice, hoping for a lucky number.
Oh.
He saw himself as a businessman. His inventory was capital, and his job was to deploy it based on facts, not hope.
He has that incredible saying that I think every trader should have on their screen. You can beat a horse race, but you can't beat the races.
Let's break that down because it's so important.
Please.
Beating a horse race is possible. You do your homework, you study the horse, the jockey, the track conditions, you find an edge, you place your bet, and you can win. You've beaten one specific event.
Okay.
But trying to beat the races means betting on every single race all day long. The house edge, the track's commission, the sheer probability of it all will grind you down to nothing. You can't win by playing every hand.
So in market terms, he's saying you can't trade every day. You can't be in the market all the time.
You absolutely cannot. He believed there were specific moments to act and then long periods where the correct move was to do absolutely nothing. And that's a hard pill to swallow today.
Oh, absolutely. With trading apps on our phones, the constant news cycle, people feel like if they aren't clicking buttons, they aren't participating, they're not trading.
And Livermore would say that constant activity is the fastest way to the poorhouse. It's just feeding your commissions to the broker. This all comes back to personal responsibility. He was adamant that you cannot delegate your thinking.
Right. The line about hiring someone to do your push-ups for you after you read a fitness book.
Exactly. You have to do the work. And for him, the work was record keeping. He started at age 14, working in a bucket shop, writing down numbers in a notebook.
Not just reading the ticker tape, but physically writing it down.
Yes. And that's where he gets into the time element. By writing it himself, he wasn't just seeing the price. He was developing a feel for the rhythm of the price. How fast did it move? How did it react to news? He was internalizing the market's behavior.
So if you just take a tip from a friend or a broker,
you don't know why you got in. So you have no idea when to get out. You're flying blind. But if you've done your own work, the market itself will tell you when you're wrong.
Which leads to maybe his most famous maxim, markets are never wrong. Opinions often are.
It's the golden rule of trading. It sounds so simple, but it is profoundly difficult to live by.
Because our egos get in the way. We do all this research, we think a stock is a bargain.
Exactly.
Yeah.
You say, this company is amazing, their earnings are great, it should be at $50, but the market is trading at a 30. Your opinion is 50. The market's fact is 30. Livermore's point is ruthless. The market is right, and you are wrong, period. End of story.
So you have to wait. You can't just buy because you think it's cheap.
You wait until the action of the market confirms your opinion. If you think it should go up, you wait for it to actually start going up before you buy.
He called being a little late a form of insurance.
That's the perfect way to frame it. You miss the first few percentage points of a move. That's your premium. You pay that premium for the confirmation that you're on the right side of the trend. Being too early is the same as being wrong.
This all boils down to psychology, doesn't it? He compares it to poker, saying that the desire to be in every pot is what destroys traders.
It's a fatal human flaw in this arena. It's boring to fold hand after hand. But his deepest insight here is what he says about hope and fear.
Ah, the great inversion. This is fascinating.
It is. In normal life, hope is a virtue and fear is a survival instinct. In the market, he says, we get them completely backward.
Walk us through an example.
Okay. You buy a stock at $30, it immediately drops to $28, you have a small loss. The average person's reaction is hope. Oh, I hope it comes back, I'll just wait.
Right, it's a good company, it'll bounce back.
And you sit there hoping as it drops to 25, then 20. Livermore says that is precisely when you should be terrified. You should fear a larger loss and sell immediately.
So you fear when you're losing. And the flip side?
The flip side, you buy at 30, it goes to 32. You have a profit. Now, suddenly you're filled with fear.
Fear of losing the profit.
Fear that it will go back to 30. So you snatch that small profit and sell. You lock it in. Livermore says this is when you should be hopeful. You should hope that this is the beginning of a major move that could take it to 50 or 60.
So traders hope when they should fear, and fear when they should hope.
Perfectly put. And that's why people cut their winners short and let their losers run, which is the exact opposite of what you should do.
Right.
It all comes down to his other great rule. Profits always take care of themselves, but losses never do.
You have to be a ruthless manager of your losses.
You have to be the grim reaper for your losing positions.
Moving into Chapter 2, he asks a really interesting question. When does a stock act right? He starts by kind of giving them personalities.
It's a brilliant teaching tool. He says stocks are like people. Some are aggressive and volatile. Others are reserved, slow, and steady. Some are hyper. Some are logical.
And you have to know who you're dealing with.
You do. You have to study a stock's past behavior. Does it tend to gap up on news and then fade? Does it grind higher slowly? You can't use the same tactics on every single stock, just like you wouldn't talk to every person in the exact same way.
And a big part of this is rejecting the idea of buying on dips. He warns about what he calls good buying levels. This feels very against the grain of modern value investing.
It is. For his style of trading, buying on a reaction or a dip is just trying to fight the immediate trend. He was all about what he called the line of least resistance.
Like a river's current.
Exactly. If the river's flowing powerfully south, you don't try to paddle north just because you see a small, calm eddy. You go with the current. If the line of least resistance is down, you sell or stay out. If it's up, you buy. You don't try to be a hero and guess the exact bottom.
This all seems to require an immense amount of patience, which he addresses directly. He says something that I think would shock most people today.
I know what you're going to say.
That there are only 4 or 5 times a year a trader should actually make a commitment.
4 or 5 times. Think about that. That means for weeks, maybe months at a time, you are doing nothing. You are sitting in cash, watching, waiting, studying.
He said that's when you're really making your money. In the waiting.
Because you're preserving your capital and, just as importantly, your emotional energy. You're not getting ground down by the daily noise. You're saving yourself for the fat pitch, the perfect setup.
And if you don't have that patience, you can become what he calls an involuntary investor. I think we've all been there.
Oh, it's the classic trap. You buy a stock at 50 as a trade. You expect it to go to 60. Instead, it drops to 40. Your ego won't let you take the loss.
So you change the story.
You change the story. You say, well, it's actually a great company. They pay a dividend. I'll just hold it for the long term. You've just turned a bad trade into a bad investment.
You've become an investor by accident.
An involuntary one. And Livermore was scathing about this. He said the money people lose on these investments dwarfs the money lost in pure speculation, because you've now locked up your capital in a losing position. And you can't use it when a real opportunity comes along. It's a prison of your own making.
It's just a way to avoid admitting you were wrong.
That's all it is. Ego.
So if you're sitting on your hands most of the year, waiting, what are you looking for? In Chapter 3, he says, follow the leaders. This seems to be his method for cutting through the noise.
It is a way to focus the universe. Even in his day, there were hundreds of stocks. Today, there are thousands. It's overwhelming. He said, "It is much easier to watch a few than many."
So you don't go digging for some obscure penny stock.
No. His rule was simple. If you can't make money in the leading, most active issues, you're not going to make money in the stock market as a whole. You focus on the big names, the sector leaders.
U.S. Steel, back in his day.
Right. And he believed that stocks move in groups. There's an underlying logic. If there's a fundamental economic reason for U.S. Steel to be going up, that same reason probably applies to Bethlehem Steel and the other major players in that group.
He had a very clear step-by-step process for this, a kind of top-down trading.
Yes, a clear cascade. Step 1, check the overall market. Is the main current flowing up or down? If the whole market is in a bear trend, you probably shouldn't be buying anything.
Don't fight the tide.
Never. Step 2, check the industry groups. Which sector is showing the most strength? Is it railroads? Is it automobiles? Find the strongest group in the strong market.
Okay, so market, then group.
Then, step 3 is to find the dominant stock within that group, the leader. But he added a really clever fourth step, which he called tandem trading, or looking at the sister stock.
I loved this part. It's like a buddy system for confirmation.
It's a great way to put it. Let's use a modern example. Say you're looking at the chip sector, and you see NVIDIA starting to break out to a new high. Before you buy, you look at its sister stock, maybe AMD. If NVIDIA is soaring, but AMD is dropping or just sitting there doing nothing, that's a red flag. It suggests the move in NVIDIA might be company-specific, not a broad industry trend. It makes the trade riskier.
But if both are moving up together,
If NVIDIA is breaking out and you look over and see AMD is also strong, maybe breaking out too, that's your confirmation. The whole family is moving. It gives you the psychological conviction to pull the trigger.
it's a way of confirming that you're not just seeing things, you're aligned with a much bigger move.
Precisely. It's about probabilities. You're stacking the odds in your favor.
Now we get to a section that I think really tells you who this man was. Chapter 4, Money in the Hand. And we have to talk about the famous bank vault story.
Oh, this is one of the all-time great Wall Street legends. It's just so visual. So you have to picture it. It's the 1920s. Livermore is on top of the world, fantastically wealthy, but he feels he's losing touch. Trading is just numbers on a piece of paper or lights on a ticker. The money doesn't feel real anymore. So he has this idea.
A very eccentric idea.
Very. At the end of the year, he goes to his bank, and he asks them to take his entire cash balance, we're talking tens of millions of dollars, and physically stack it in the main vault.
He wanted to see it. Piles of cash.
Not just see it. He had them bring in a table, a chair, groceries, cold cuts, and a bottle of whiskey to make old fashions. And he had them lock him in the vault for the weekend.
No way.
Yes. He spent the entire weekend alone, surrounded by his fortune, just sitting there reviewing every single trade he'd made that year.
Why? What was the point?
He needed to touch the money. He needed to feel the weight of it, to regain perspective on its power and what his decisions, good and bad, had actually created. It was his way of grounding himself in reality before the next trading year began.
That's incredible, and it speaks directly to his core role in this chapter.
It does. His rule was, after any successful trade, take 50% of the net profits and physically remove them, lock them away, put them in a safe deposit box, get them out of your brokerage account.
Not just leave it in the account to compound. That's what everyone tells you to do.
He was against it for two reasons. First, what he called the get-rich-slow mindset. If you leave all the money in there, the temptation to make another huge bet, to get reckless, is too high.
You get cocky.
You get cocky. Second, he was very wary of the broker relationship. Brokers, he said, make money from commissions. They want you to trade. If the money is sitting in your account, it's like a poker chip on the table, begging to be played. If it's in a bank vault, it's yours. It's real. It's safe.
He also had a very strict rule about margin calls in this section.
An absolute ironclad rule. Never meet a margin call.
So if the broker calls and asks for more money to cover a losing position...
You sell the position
Yes.
immediately. The margin call is the market sending you a telegram that says you are wrong. To send good money after bad was, in his view, the ultimate sin.
So many of these rules are about removing emotion and ego.
Almost all of them are. Which brings us to the core of his actual timing method in Chapter 5. The pivotal point.
This feels like the holy grail of his system.
It is. The pivotal point isn't just a price. It's a psychological moment. It's this point where a stock that has been churning, building a cause, finally makes up its mind and the real move begins.
And his job was to identify that exact point.
His job was to have the patience to wait for it and then the courage to act on it instantly. He broke them down into two main types.
The reversal and the continuation pivotal points.
Correct. A reversal pivotal point is just what it sounds like. It marks a major change in the primary trend. Say a stock has been in a bear market for a year. It hits a low, bounces, goes back down to test that low, holds, and then breaks above the recent bounce high. That break is the reversal pivotal point. It's the signal that the character of the market has changed.
And the continuation point.
That's different. That happens inside an already established trend. So a stock is in a strong uptrend, and then it pauses. It goes sideways for a few weeks, consolidating its gains. You get this great military analogy for it.
The general resting his troops.
I love that. The army is pausing to regroup before the next advance. When the stock breaks out of that consolidation range to a new high, that's the continuation pivotal point. For Livermore, that was the signal to add to his position.
And how does volume fit into this? Was he watching that?
Volume was everything. Volume was the alert signal. It was the confirmation. If a stock crossed a pivotal point on low and even volume, he was immediately suspicious. He wanted to see a surge of activity, a big spike in volume.
Why was that so important?
Because it told him that other big, important players, the smart money, saw the same thing he did. It confirmed that the move was real and had power behind it. Low volume means low conviction.
He gives that great example with Anaconda Copper.
Yes, it's a fantastic illustration of reading the market's behavior. He noticed that when Anaconda crossed psychological levels like $100 and $200, it moved fast. It exploded higher. Those were clean, powerful, pivotal point breaks.
The 300 was different.
300 was different. When it crossed that level, it was sluggish. It struggled. It felt heavy. He could see on the tape that supply was now meeting and overcoming the demand. That change in behavior at the pivotal point was his signal that the big move was likely over. The character had changed.
It's all about watching the action, not just the price.
The action is the truth. He tells another story about the cocoa market. He waited for months for it to reach a specific pivotal point he had identified. The moment it hit that point, he bought, and it went on a 600-point run over the next 5 months. The money wasn't made by guessing. It was made in the waiting.
But even a master like Livermore could fail to follow his own rules. Which brings us to the cautionary tale in Chapter 6, the $1 million blunder.
This is such a painful but vital story. It's all about emotional control.
So this was a trade in the cotton market.
Right. He'd done all his homework. He was convinced cotton was setting up for a massive bull run. He planned to buy 100,000 bales, and he had identified the exact pivotal point where the move should begin.
But he didn't wait for it.
He got impatient. He got antsy. He thought, you know what, I can see it coming. I'll just jump in and scalp a quick small profit before the real move starts.
A classic mistake.
A fatal one. He buys a little. The market does nothing. He sells for a small loss. He tries again. It drifts sideways. He sells again. He keeps doing this, getting chopped up by a market that's just not ready to go yet.
And he ends up losing around $200,000. A lot of money, but not a disaster for him.
The money wasn't the disaster. The psychological damage was. He got angry. He got disgusted with the market. He essentially said, forget this, and he stopped paying attention. He walked away.
And of course, that's when it happened.
That's when it happened. A few days later, cotton hit his original pivotal point. It broke out, and it went on the massive bull run he had predicted. He would have made $1 million. Instead, he made nothing and lost 200 grand, all because he exhausted his emotional capital.
That is such a relatable story, getting angry at a stock and just wanting to wash your hands of it, only to see it take off without you.
It's the get-rich-quick, impulse-sabotaging the get-rich-sure plan. And out of this painful mistake, he developed his probe system.
This is his method for entering a position, right? He never goes all in at once.
Never. He sends out a probe, like a scout. If his full position size is, say, 1,000 shares, he'll start by buying maybe 200.
And then he waits.
He waits to see if he's right. If the stock immediately goes up a little, that's the market confirming his initial judgment. Only then will he buy another 200 shares.
And he buys that next lot at a higher price than the first.
Yes, and this is critical. It's the absolute opposite of averaging down.
Which is what most people are taught to do. Buy more as it gets cheaper.
Which Livermore considered financial suicide. If you buy at 50 and it drops to 47, buying more is just throwing good money after bad. You're reinforcing a mistake. Livermore's rule was you only add to a winning position. Every new purchase must be at a higher price because that is proof your judgment is correct.
That takes so much discipline. It's hard to pay more for something than you did just a few hours ago.
It is. But he would argue you're not paying for the stock. You're paying for the confirmation. You're buying certainty.
In this chapter, he also mentions something that sounds a bit mystical again, the inner mind tip-off.
It does sound a bit out there, but he grounds it in experience. He described moments where he would have a sudden, inexplicable urge to sell a position, even if everything looked fine on the surface.
An intuition.
He compared it to a cat suddenly getting spooked for no apparent reason. He believed it was his subconscious mind picking up on subtle changes in the rhythm of the market. The tape that his conscious brain hadn't processed yet. It was pattern recognition on a very deep level.
So intuition is really just experience processed instantly.
I think that's exactly how he saw it. But he did warn that you have to be very careful to distinguish a true inner voice from simple fear or greed.
Which is why you need the hard rules to fall back on. And that brings us to the final section, a summary of his laws. Let's start with the big one, the 10% loss rule.
This is his ultimate circuit breaker, the non-negotiable backstop. Never, under any circumstances, sustain a loss of more than 10% of your invested capital on any single trade.
Why that specific number? Why 10%?
It's the simple, brutal mathematics of recovery. If you lose 10%, you need about an 11% gain to get back to even. That's manageable. If you lose 50%, you need a 100% gain just to break even.
Which is a monumental task.
It's incredibly difficult. The 10% rule prevents a small mistake from turning into a catastrophic one. It takes the hope and the ego out of the equation. The price hits your stop, you're out. No debate.
He also viewed time itself as a key trading dimension.
Yes. We always focus on price, but time is just as important. His view was that your money should not be idle in a position. If you buy a stock and it does nothing, you just sit there for weeks, he'd say, get out.
Even if you haven't lost money.
Even if it's a break even. He said, you're losing opportunity cost. That capital could be deployed in something that is moving. His idea of sitting and waiting applied to the time before you enter a trade, not while you're languishing in one.
All of this, at the end of the day, comes back to the one constant, the human element.
That's the quote that echoes through the decades. Wall Street never changes because human nature never changes.
The technology is unrecognizable from his era, but the people are the same.
Exactly. The game is played with supercomputers and algorithms now, but the emotions driving the decisions, the greed, the fear, the hope, the ignorance, they are identical to what they were in 1924.
We think we're so much more sophisticated, but we're still susceptible to the same psychological traps.
We absolutely are. And that's what makes Livermore's own life story so tragic and so instructive. He figured out the market. He created a system that worked. But he could never fully conquer the enemy inside himself.
A man who made and lost several fortunes, proving that discipline isn't just part of the game, it is the game.
It is the whole game. If you take one thing from this book, it should be that. Treat it as a business, know yourself, and control your emotions. Or they will absolutely control you.
A powerful lesson from a true legend of the market. I think that's the perfect place to leave it.
I agree. A timeless text.
Thank you for watching, LA. Please like, LA, share, subscribe, follow up in next topic. Come back to continue how to trade in stocks.
It is great to be back. And honestly, if our last session was, laying the foundation, understanding the man, the myth, the philosophy of Jesse Livermore.
Right.
Today is where we actually start pouring the concrete. We're building the skyscraper.
I love that visual because last time we spent a lot of time on the biography, The Boy Plunger, the guy who made millions, lost millions, and really treated the market like this high-stakes puzzle that only he could solve.
Exactly.
We talked about his general attitude, right? Treating like a business, not a casino. But today feels different. This feels like we are moving from the biography section of the bookstore to the instruction manual section.
That is exactly right. We are moving from the what to the how. We're opening the hood of the car to see the engine. In part one, we established Livermore's core belief. Wall Street never changes because human nature never changes. Today, we are going to look at the specific formulas he built to exploit that very fact. We are talking about his rules for timing, his incredibly strict money management systems, which, frankly, are terrifyingly disciplined.
Oh, yeah.
And, of course, the emotional control required to actually execute any of this without losing your mind.
And I think that's what everyone listening has been waiting for. It's one thing to hear buy low, sell high, which, spoiler alert for anyone listening, Livermore actually disagreed with.
He really did.
But it's another thing to have a checklist. And looking at the research you've pulled together, we have a serious roadmap today. We're going to unpack that legendary $3 million profit story to understand the true mechanics of patience. We're going to decode TDT, top-down trading.
Which is arguably the most critical part of his pre-trade routine. I mean, if you get TDT wrong, honestly, nothing else really matters.
We'll also talk about sister stocks, which sounds like a folk band, but is actually a vital trading signal.
It's a brilliant concept. Yeah.
And then the stuff that keeps you alive.
Right.
The 10% rule, and why cash is sometimes the most aggressive position you can possibly hold.
And finally, we have to tackle the psychology in Chapter 10. Because you can have the most perfect mathematical system in the world, but if you don't have the will to follow it, if you panic the second the screen turns red, it is absolutely useless.
So let's jump right into the deep end. We need to talk about patience. Now, in the book, specifically Chapter 7, Livermore tells the story about a wheat trade. And reading through it, it's not just a I bought wheat and got rich story. It's a story about the absolute torture of waiting.
It really is. It's the defining story of his maturity as a trader. You have to remember, early in his career, Livermore was a scalper. He was in the bucket shops, reading the tape, grabbing 1 point here, half a point there. He was all about speed.
Right.
But as he started dealing with millions and millions of dollars, he realized that approach just didn't scale. You can't scalp with huge positions. You move the market too much. The wheat trade illustrates what he coined psychological time.
Psychological time? That's a heavy term. How does that differ from, say, just looking at a calendar?
Well, think about how most people trade today. They look at a chart, they see a price, and they think, wow, wheat is cheap. It's at a 52-week low, I'll buy.
Yeah, that's the instinct.
They're operating on clock time or price time. They think because it's cheap now, it must go up now. Livermore operated completely differently. In this specific instance, he was incredibly bearish on wheat. He knew the supply and demand factors, the fundamentals, were skewing heavily towards a price drop.
So he knew it was going to crash. He had the thesis.
He was 90% sure.
Yeah.
But, and this is the key that separates the amateur from the pro, he didn't just short the market immediately.
Which feels so counterintuitive. If you know it's going down, why not get in early and catch the whole move? Why leave all that money on the table?
Because being right too early is exactly the same as being wrong.
Wow. Say that again?
Being right too early is being wrong. If you short it and the market just drifts sideways for 3 weeks, or it rallies just a little bit on some random piece of news, you get squeezed out. You lose your capital before the big move even starts. You die of 1,000 cuts before the battle even begins.
Okay, so how did he handle it? He's sitting there, he knows wheat is doomed, but the price just isn't moving yet. What does he do?
Livermore used what he called probes. He didn't just jump in with his full position. The text mentions he actually used a different commodity rye to test the waters first.
He's used rye.
He bought some rye as a testing operation just to ascertain the position of the wheat market.
He used rye as a canary in the coal mine? That's fascinating.
In a way, yes. Rye and wheat, they tend to trade in sympathy. When he saw the reaction in rye and he felt the weakness there, he knew the sentiment was shifting. But even then, he didn't go all in on wheat. He waited for a pivotal point.
Ah, the pivotal point.
He waited for the market to break a specific support level that confirmed his thesis. He intentionally missed the first chunk of the drop.
That is so hard to do. I mean, everyone wants to catch the top tick. They want to sell at the absolute peak to feel like a genius. Livermore is saying, no, let it drop. Let it prove you right.
He wanted the market to sign the contract before he committed the money. He called this psychological time. It's that specific moment where the mass psychology of the market shifts, the dam breaks, and the move becomes, well, inevitable.
And by waiting for that signal,
he minimized his time risk. He wasn't sitting in a dead position for months wondering if he was crazy. When he finally entered, the market moved almost immediately in his favor.
And the result of that patience.
A $3 million profit.
$3 million. And we have to remind ourselves, this is the early 20th century. Adjusted for inflation, that's, what, tens of millions, maybe $100 million today?
It's generational wealth. But the money was just the result. The skill was the patience. He has this famous quote, "It's not the thinking that makes the money, it's the sitting and waiting."
The sitting and waiting.
And that applies to sitting in cash, staring at the screen, and doing absolutely nothing until the setup is perfect.
I love that. It's probably the hardest thing to do, just sit on your hands. We're wired to act. We feel like if we aren't clicking buttons, we aren't working.
Right.
But let's say you've waited, you're patient, you're ready to trade. How do you know what to trade? This brings us to Chapter 8 and this acronym you've highlighted, TDT, top-down trading.
TDT is Livermore's flight checklist. Think of it like a pilot before takeoff. You don't just rev the engine and hope for the best. It's a systematic approach to ensuring the probabilities are stacked in your favor.
Okay.
He didn't just wake up and say, I think General Motors looks good today. He went from the macro to the micro.
Okay, let's unpack the checklist. There are 4 distinct steps here. Step 1 is simply the market.
Right. TM, the market. This is the big picture view. Is the overall market, the Dow, the NASDAQ, the S&P 500 moving up, down, or sideways? Now, interestingly, Livermore tried to avoid the words bull and bear.
Really? Those are the classic Wall Street terms. Why would he avoid them?
He felt they made you rigid. If you call yourself a bear, you're constantly looking for bad news. You're biased. Instead, he looked for the line of least resistance.
The line of least resistance, like water flowing downhill.
Precisely. If you drop a ball, gravity takes it down. That's the line of least resistance. In the market, if the selling pressure is stronger than the buying pressure, the line is down. Livermore's logic was, if the wind is in your face, why try to sail? If the overall market is trending down, buying a stock, even a really good company, is just fighting gravity. So, step 1, establish the direction of the entire tide.
Okay, so let's say we check the tide and it's coming in, the market is looking good. We move to step 2, the industry group. TIG.
This is vital and honestly where most amateurs completely fail. Stocks don't move alone, they move in herds. Livermore said, and this is a quote, understanding industry group action is essential to successful trading.
So if you want to buy an oil stock, you don't just look at Exxon.
No. You look at the oil index, you look at Chevron, BP, Shell. Are they all moving together?
So if I like a specific tech stock, but the entire tech sector is tanking, I should just stay away.
You absolutely should. It's like buying the best house in a neighborhood that's on fire. Eventually, the fire is going to catch your house too.
Right.
Or, to use a more positive analogy, you want to be in the sector that is leading the charge. If the market is rallying, but the rally is being driven by utilities and healthcare, don't go buying semiconductor stocks if semis are lagging. You want to be where the money is flowing.
Got it. So market is good, industry is good. Now we get to step 3, which is one of my favorites in this research, tandem trading, the sister stock theory. This is where it gets really tactical.
It is a brilliant psychological check. Livermore said, never look at just one stock, look at 2 in the same group.
Why 2? What does the second one tell you that the first one doesn't?
Confirmation. It proves the move is real. If you're looking at General Motors, you must also look at Ford or Chrysler. If you're looking at Home Depot, look at Lowe's. In the updated commentary of the book, they use the example of the dot-com bubble with Yahoo and AOL.
Oh, good throwback.
Right. If you're bullish on Yahoo and it's skyrocketing, but AOL is just sitting there flat or worse, dropping, that is a massive warning sign.
So the sister stock acts as a reality check.
It does. If the institutional money, the smart money, is really moving into a sector, they lift all the boats. If only one boat is rising, it might just be a rumor or some kind of manipulation.
It's like if you see one person running down the street, they might just be late for a bus. If you see 2 people running down the street looking scared, you should probably start running too.
That is a very, very apt analogy. The sister stock validates the trend. If they diverge, you stay out. You don't guess, you wait.
And finally, step 4, due diligence on the stock itself.
Yes, once all the macro lights are green market, industry, sister stock, then and only then do you look at the specific company. This is the final check. And there's a great analogy in the source material from Richard Smitton's military friend. He compares TDT to a marine beach assault.
Oh, yeah, the marine assault. I loved this visualization. It really drives home the seriousness of the whole operation.
Well, think about it. Before Marines storm a beach, they don't just run out of the boats blindly. They analyze the weather. That's the market. They analyze the beach terrain. That's the industry.
Right.
They look at the enemy fortifications and the flanking positions. That's the sister stocks in competition. They gather every scrap of intelligence they can. They know the assault won't be perfect. There's always the human factor. But they do not move until the preponderance of evidence is in their favor.
Preponderance of evidence, that's the key phrase. You're not gambling on a hunch. You're executing a strategic plan based on evidence.
Exactly. And within that plan, there's another rule Livermore was adamant about, which is very painful for bargain hunters. Follow the leaders?
This one is tough. Livermore said, trade the strongest stock in the strongest group.
Yes. Human nature makes us want to buy the cheap one. Let's say we're looking at the semiconductor group. NVIDIA is trading at $500. Other smaller chip maker is trading at $20. We think, oh, the $20 one has more room to grow. I can buy more shares. Livermore said that is a trap.
Why? Why isn't the cheap one a bargain?
Because the market is smart. The leader is the leader for a reason. It has the momentum, the earnings, the institutional backing. The cheap stock is usually cheap because it's weak. Maybe it has bad management or it's losing market share. Livermore called them weak sisters.
Wheat sisters.
Brutal. He said, don't look for bargains. Don't try to catch a falling knife. If you were going to trade the one that is leading the pack. It is safer to be in the strongest stock because it has the force of the market behind it. When the market rallies, the leaders rally first and furthest.
Okay, so we've picked our stock, we're watching the leader. Now we need to know exactly when to pull the trigger. This moves us into Section 3, Market Signals and Patterns, also in Chapter 8. We touched on pivotal points earlier, but let's get specific. What does a pivotal point actually look like on a chart?
Livermore identified two main types. The first is the reversal pivotal point. This is the perfect psychological moment to enter when a trend changes direction. Imagine a stock has been dropping for months. It hits a low, it bounces, it drops again, but doesn't go lower, and then it rallies past the previous bounce. That creates a sort of W shape. The moment it breaks that middle point of the W, that's the reversal. That's the moment buying pressure has finally definitively overwhelmed selling pressure.
And the second type?
The continuation, pivotal point. This is for when you are already in a trade or you're looking to add to it. The stock might pause, consolidate, go sideways for a few weeks to catch its breath, and then boom, it breaks out again in the same direction. That confirms the trend is still alive and well.
But knowing when to get in is only half the battle, maybe less than half. We need to know when to run for the hills. The book talks about danger signals. One of them is the one-day reversal, or ODR. Walk us through that, because it sounds pretty frightening.
This is a very specific, very dangerous pattern. You need to visualize the emotion of the day. Imagine a stock has been climbing for weeks and weeks. Everyone is happy, greed is high. On this specific day, the excitement is at a fever pitch. The stock opens, rallies hard, and makes a new high for the entire move.
Sounds great so far. Everyone is making money.
It feels great. But then, usually in the afternoon, something changes. Selling comes in. Heavy selling. The stock starts to drop. It gives back all the gains of the day. And crucially, it closes near the bottom of its range and below the previous day's close, all on higher than normal volume.
So it tried to go up, hit a brick wall, and got shoved back down into the basement, all in one day.
Precisely. It signifies a massive shift in control from the buyers to the sellers. The high volume part tell you that big money was distributing selling stock into that morning rally. They were using the public's excitement to unload their shares.
Wow.
If you see a one-day reversal after a long run-up, Livermore says that is an immediate signal to exit. The party is over.
Another signal he talks about is the breakout on a new high, or BONH. Now, I feel like modern traders are kind of used to this idea, but back then, and honestly even today, buying a stock at an all-time high feels really risky.
It was considered reckless. The conventional wisdom was buy low, sell high. If a stock was at a new high, people thought it was too expensive. Livermore took the completely contrarian view. He said a stock making a new high is actually the safest buy you can make.
Why? I mean, isn't it expensive?
It's all about supply and demand. He talked about overhead resistance. Imagine a stock was at $50, then it dropped to $40. There are a lot of people who bought at $50 who are now losing money. They are holding the bag.
Oh, I've been there. You just pray for it to get back to 50 so you can sell and get your money back.
Exactly. You and thousands of others.
Yep.
That creates a wall of sellers at $50.
Yeah.
That is resistance. But if a stock breaks out to an all-time high of $60, who is losing money?
Nobody.
Nobody. Everyone who owns the stock is in profit. There are no bag holders waiting to sell to break even. The sky is clear. That is why new highs often lead to even higher prices. There is no resistance holding it down.
That makes perfect sense. It's blue sky territory. Now, you mentioned volume earlier. Livermore seemed to be obsessed with volume.
Volume is the fuel. Price is the vehicle. Without fuel, the vehicle stops. Livermore looked for volume that was at least 50% above normal to signal a significant event. He treated volume as an alert signal. But specifically, he watched for high volume at the end of a long move.
What does that indicate?
Distribution. If a stock has been going up for months and suddenly you see massive volume, millions of shares trading, but the price isn't moving up anymore, that is a red alert. It means the smart money is selling their shares to the public, who are rushing in late, because of FOMO. The insiders are distributing their stock to the outsiders.
It's a transfer of risk from the pros to the Joes.
Correct. And you do not want to be the Joe holding the bag when the music stops.
Okay, so we have the timing down, we know the signals, but as Livermore says, you can have perfect timing and still go bankrupt if you don't manage your chips. This brings us to Section 4, Money Management, covering Chapter 9. And honestly, this is the part that separates the pros from the gamblers.
I would argue it's not just what separates them, it is what ensures survival. Chapter 9 outlines some incredibly strict rules, and the first one is the probing system.
This is about how you buy, right? You don't just shove all your chips in at once.
Never. You never go all in on the first buy. Livermore used a pyramiding strategy. Let's say you have enough money to buy 1,000 shares. You don't buy 1,000, you buy 200. That is your first probe.
Okay, 20%. Then what?
Then you wait. You wait to see if you are right. If the stock goes up, and only if it goes up, you buy the next 200.
Wait, you buy at a higher price. That hurts my bargain hunting soul. I want to lower my average cost.
That is the amateur instinct. Averaging down, buying more when the price drops, is the quickest way to the poorhouse. Livermore said, average up. Think about it. If the stock is rising, your judgment has been confirmed. You are backing a winner. If the stock drops after your first buy, you were wrong. Why would you put more money into a losing trade?
That is a hard pill to swallow, but logically it's undeniable. You feed the winners, you starve the losers. So what was his ratio?
He usually went 20, 20, 20, 40. Start with 20%. If it acts right, another 20%, then another 20. If it's still acting right, then you commit the final 40%. By the time you are fully invested, you're already sitting on a profit from those early buys. You have a cushion.
And what if it goes the other way? What if you buy that first 20% and it just tanks?
That brings us to rule number 2, the 10% loss rule. This was absolutely non-negotiable for him. Never sustain a loss of more than 10% of your invested capital.
10%? That's a tight leash, especially in volatile markets.
It has to be. And here's the math, which Livermore understood deeply. If you lose 50% of your money, how much do you need to make just to get back to even?
Well, if I have $100 and lose 50, I have 50 left. To get back to 100, I have to double it. I need a 100% gain.
Exactly. And doubling your money is incredibly hard. Recovering from a 10% loss is manageable. You just need an 11% gain. Recovering from a 50% loss is a nightmare. So Livermore's rule was automatic. If a stock drops 10%, sell. No questions. No, maybe we'll come back. Just sell.
He called it protecting the line.
Yes. Your capital is your inventory. If you're a store owner and you have no inventory, you are out of business. If you're a trader and you have no cash, you are finished. You're out of the game.
Which leads right into Rule 3. Cash is king.
Time is time. Money is money. Livermore believed that there are times when your money should be inactive, just sitting on the sidelines.
Being in cash is a position.
It is a position of power. It allows you to strike when the perfect trade appears. If your money is tied up in dead stocks that are doing nothing, you can't take advantage of the new opportunity. Patience allows you to deploy cash when the odds are overwhelmingly in your favor.
And finally, Rule 4. What do we do when we actually make some money?
Taking profits, but not just taking them, making them real. Livermore had a rule. If you double your capital in a trade, take 50% of the profit out, wire it to the bank, put it in a safe deposit box.
Why? Just to protect it from himself.
Partly protection, but partly psychology. He said that on the screen, money is just paper figures. It's just numbers. It doesn't feel real. He needed to touch the money to feel the reality of it. In fact, there's a famous story about his vault ritual.
Oh, tell me this one.
So at the end of every year, he would liquidate his positions. He would take millions of dollars in actual cash bills and put them in a bank vault. Then he would go into the vault and just sit with the money.
He would just sit there with the cash, like Scrooge McDuck.
For days. He would surround himself with the physical currency. It was his way of grounding himself, reminding himself that these weren't just blips on a ticker tape. This was real power, real wealth. It reset his mind for the next year. It prevented him from treating the market like a video game.
That is wild, but it makes a certain kind of sense. It connects the digital abstraction to physical reality. And that mental game is the perfect segue to Section 5. Emotional control, found in Chapter 10.
The psychology of the market. Livermore said, the market never changes because human nature never changes. He identified the four horsemen of the speculator: greed, fear, ignorance, and hope.
And hope is the surprising one there. We usually think of hope as a good thing.
In life, hope is a virtue. In the market, hope is a poison. When you are losing money, you hope it will go back up. That hope stops you from taking the small loss.
Right.
When you're making money, you fear you'll lose it, so you sell too early. You should reverse those. You should fear your losses getting bigger and hope your profits grow.
Wow. Reverse your natural instincts. That requires incredible discipline.
It does. And to maintain that discipline, Livermore had a very, very strict routine. He treated himself like a professional athlete.
Tell us about his day.
Silence.
Yeah.
He worked alone. He didn't want to talk about his trades. Talking breaks the spell. It invites doubt or it invites validation seeking. He stood at the ticker, literally stood up to stay alert.
Oh.
He went to bed early, 10 p.m., up at 6 a.m., light eating. He knew that physical exhaustion leads to poor emotional decisions.
He really did treat it like a high-performance sport.
He had to. The mental strain is immense. And part of that strain comes from outside noise. Tips. Livermore absolutely hated tips.
Beware of inside information. All inside information.
There is a classic story about a dinner party. Livermore is chatting with the chairman of a massive corporation. The chairman tells him, confidentially, our earnings are going to be fantastic. We've turned the corner. It's going to be great.
That sounds like the Holy Grail, the CEO telling you good news before it's public.
Most people would mortgage their house and buy immediately. Livermore went to his office and watched the tape. The tape showed selling. The price was heavy. The volume was distribution.
So the CEO says buy, but the tape says sell.
Livermore followed the tape. He shorted the stock.
Yeah.
The stock tanked. The earnings might have been good, but the market didn't care. Or maybe the smart money knew something else was wrong. The lesson was, executives are optimists. The tape is a realist. Never listen to tips, even from the top.
That is a hard rule to follow. We love gossip. We love being in the know.
It leads to ruin. Livermore said knowing what to do is easy. Having the will to do it is hard.
And he had a test for that will, specifically regarding sleep.
The sleeping level. If you were lying in bed, staring at the ceiling, worrying about a position, your position is too big, period. You must sell down to the sleeping level.
Mm-hmm.
Your subconscious knows you are overexposed. You have to listen to it.
That is great advice for trading and for life, honestly. If you're losing sleep over it, change the situation. Now, as we wrap up, let's look at Section 6, Modern Application. Because this book was written in 1940, does any of this still hold up?
Or absolutely. In fact, Chapter 11 talks about the computer interpretation of his system. Remember, Livermore was a math guy. He looked for patterns. Today we call that algorithmic trading.
So the high-frequency trading bots of today are basically just doing what Livermore did in his head.
They're looking for pivotal points. They're looking for volume anomalies. They're looking for new high breakouts. The speed has changed, but the logic, the mathematical analysis of price and volume is the foundation of modern technical analysis.
The book also touches on this concept of the human mind wheel in Chapter 12.
Yes, it's a great visual. It shows the speculator at the center, surrounded by enemies. Fear, greed, ignorance, hope. It's a powerful reminder that the battle isn't against the market. The battle is against yourself.
So if we were to create a cheat sheet or a summary of laws from this deep dive for our listener Livermore's secret rules to stock market success summarized, what does that look like?
I would break it down to the 3 pillars. 1, market timing. Sitting and waiting makes the money.
Mm-hmm.
Use top-down trading, TDT, to make sure the wind is at your back.
Okay.
2, money management. Protect the line. Cash is inventory. Use the 10% hard stop. No exceptions.
Right.
And 3, emotional control. Silence. Poise.
Expert.
Ignore all opinions, even your own, in favor of what the tape is telling you.
It's simple, but it's not easy.
Simple to understand. A lifetime to master.
And that brings us to our final synthesis. Reading all of this, you realize Livermore didn't view trading as gambling at all. He viewed it as a profession, like law or medicine.
That is the crucial takeaway. You wouldn't walk into an operating room and start doing surgery because you have a hunch. You study anatomy. You follow protocols. Livermore is saying, respect the market. Study the market. Treat it with the gravity of a surgeon. If you treat it like a casino, the house will eventually take everything.
So here is our challenge to you, the listener. We've covered a lot of rules today. TT, the 10% rule, sister stocks. Don't try to do it all at once. Pick one. Maybe it's the 10% stop loss. Maybe it's checking the sister stock before you buy anything this week. Apply that one rule religiously and just see how it changes your decision-making process.
I would suggest the 10% rule. It is the one rule that absolutely ensures you live to trade another day.
Great advice. Thank you for joining us on this journey through the mind of a legend. It's been a fascinating ride.
It certainly has. A pleasure.
Thank you for watching us. Please like us, share, subscribe, follow up in next video.